You're scrolling through financial news, and you see it. Copper just hit $13,200 per ton. The headlines are screaming about all-time highs, record prices, historic rally. And your first thought is probably something like, this is another commodity bubble, right? Speculators driving up prices. China doing something weird, maybe a supply disruption that'll fix itself in 6 months. Just another spike that'll crash back down like it always does. That's exactly backwards. Because what's happening to copper right now isn't a spike, it's not speculation, it's not temporary. This is the beginning of a fundamental repricing of a metal that the entire modern world runs on, and the gap between supply and reality is about to get a whole lot wider. My name is Alex, and for the past decade I've been tracking commodity markets and industrial demand trends because I realized something most investors miss. The biggest wealth transfers don't happen in tech stocks or crypto. They happen when physical reality collides with financial markets, and nobody sees it coming until the price has already moved. If you're trying to understand where real money flows in the next 10 years, make sure to hit that subscribe button and give this video a thumbs up, because what's driving copper prices right now is the same force that's going to reshape every portfolio by 2030. Here's what you need to understand. Copper just did something it's never done before. It closed above $6 per pound. That's $13,230 per metric ton on the London Metal Exchange. That's not just a new record. That's a 43% gain year over year, the best annual performance since 2009. And here's the thing that should make your ears perk up. 2009 was coming off the financial crisis. That was a snapback rally from a collapse. This is happening during a period of relatively stable global growth. No crisis, no emergency, just relentless, grinding demand meeting a supply chain that physically cannot keep up. Now I know what you're thinking. Commodities always do this. They spike, everyone panics, new supply comes online, prices crash, it's cyclical. Except that's not how it actually works this time. And the reason comes down to three forces that have never converged like this before. Electric vehicles that require 3.5 times more copper than combustion engines. Data centers for artificial intelligence that need massive power delivery infrastructure, and grid modernization mandates across every developed economy that create non-discretionary industrial buying. These aren't cyclical trends. These aren't discretionary purchases. This is structural demand that doesn't go away when the economy slows down. And here's what nobody's telling you. The mining industry cannot respond fast enough even if every executive on Earth wanted to. The average timeline to develop a new copper mine from discovery to production? 16 to 29 years. Let that sink in for a second. If we found a massive new copper deposit tomorrow and had unlimited funding and zero regulatory issues, you wouldn't see meaningful production until 2040 at the earliest, and demand is projected to double by 2035. Let me paint you a picture of what's actually happening right now. You're an automaker. You've committed to electrifying your entire fleet by 2030 because governments in Europe and California have mandated it. You don't have a choice. Every single battery electric vehicle you build requires 83 kilograms of copper. Your old combustion engine cars, 23 kilograms. You just quadrupled your copper needs per vehicle. Now multiply that across every automaker on Earth. Toyota, Volkswagen, General Motors, Tesla, BYD, all of them racing to build millions of electric vehicles. Sprott Asset Management estimates electric vehicles alone will consume 2.8 million tons of copper annually by 2030. That's more than the entire annual production of Peru, the third largest copper-producing country on Earth, for one sector. And that's before we talk about what's happening in the data centers. Because here's where it gets really interesting. Artificial intelligence doesn't just need processors and chips, it needs power, massive amounts of power. And power infrastructure is built with copper. Every transformer, every cable, every distribution system. The International Energy Agency projects that data center electricity demand will double by 2030. Macquarie estimates that data centers will consume 330,000 to 420,000 tons of copper annually by 2030. Some projections go as high as 500,000 tons. That's an entire new demand source that didn't exist 5 years ago, and it's growing exponentially. You're not just building a few data centers. You're building the physical infrastructure for an entirely new technological era, and every watt of power delivery requires copper wire. And then there's the grid itself. This is the part most people don't think about because it's invisible. The electrical grid in the United States was built between 1950 and 1980. It's old. It's outdated. It can't handle the load requirements of modern electrification. Europe has the same problem. China's been rebuilding theirs for 20 years. Grid modernization isn't optional. It's not something governments can delay. When the grid fails, economies stop. So you have mandates, infrastructure bills, multi-trillion-dollar commitments across developed nations to upgrade transmission lines, substations, transformers, all copper-intensive. This is baseline demand that exists regardless of economic cycles. A recession doesn't make the grid less necessary. What I'm about to show you next is the thing that took me years to actually understand, because when you first look at copper supply, the numbers seem fine. Global mine production in 2024 was 23 million metric tons. That sounds like a lot. But here's what those aggregate numbers hide. Mine output isn't growing the way it used to. In fact, it's barely growing at all, and the reasons are structural, not cyclical. Let's start with geology. The easy copper has been found. The high-grade deposits that made mining profitable for a century, they're depleted. Ore grades have been declining for decades. That means miners have to move more rock to get the same amount of copper. That means higher costs, more energy, more time. Chile produces 23% of global copper, 5.3 million tons annually. But Chilean mines are old, ore grades are falling. Production has been flat for years despite massive investment. The Democratic Republic of Congo produces 14%, 3.3 million tons. But the DRC has political instability, infrastructure problems, and artisanal mining concerns that make scaling difficult. Peru produces 11%, 2.6 million tons, but faces permitting delays and community opposition to new mines. China produces 8%, 1.8 million tons, but most of that is consumed domestically. The United States produces 5%, 1.1 million tons. Also mostly domestic consumption. You see the pattern here? The top 5 producing nations control 61% of global supply, and every single one of them faces constraints that make rapid production increases nearly impossible. This isn't a cartel restricting supply, this is physical reality. You can't just turn on more copper like you turn on a faucet. Now here's where the math gets uncomfortable. China Securities Company forecasts a global copper deficit of 100,000 tons in 2026. Citi forecasts a refined copper shortage of 308,000 tons in 2026. Goldman Sachs has a long-term price target of $15,000 per ton by 2035. These aren't fringe predictions. These are major financial institutions looking at supply and demand fundamentals and realizing the numbers don't add up. And the market is starting to price that in. That 43% gain in 2025, that's not speculation. That's the market realizing there's a structural deficit coming and it can't be fixed quickly. But here's the thing nobody's talking about. This entire situation assumes nothing goes wrong. No major mine disruptions, no geopolitical issues, no labor strikes, no environmental disasters. If anything goes wrong in any major producing region, the deficit gets worse. And things go wrong all the time. A strike at a Chilean mine can take hundreds of thousands of tons offline. A permitting delay in Peru can push new production back years. A political crisis in the DRC can disrupt exports. The copper supply chain is fragile, concentrated, and operating at the edge of capacity. There's no slack in the system. If you've made it this far, you're already ahead of 90% of people who just see a commodity price chart and assume it's temporary. But don't stop now, because what comes next is where most analysts completely miss the story. They look at copper and see an industrial metal. They miss the psychology. They miss the cascading effects. They miss what happens when you combine inelastic supply with accelerating demand and long development timelines. This is where the real repricing happens. Let's talk about what inelastic supply actually means in practice. In a normal market, when prices go up, supply responds. Farmers plant more crops. Oil companies drill more wells. Manufacturers build more factories. Supply increases, prices stabilize. That's economics 101. But copper doesn't work that way. You can't just plant more copper. You can't drill a well and hit copper next month. The response time is measured in decades, not quarters. So what happens when you have demand growing at 5 to 7% annually and supply growing at 1 to 2%? You get a gap. And that gap widens every year. And the only mechanism to balance the market is price. Price has to rise high enough to either destroy demand or incentivize marginal supply. But here's the problem. Most of the new demand isn't price sensitive. Electric vehicle mandates don't go away because copper is expensive. Grid infrastructure doesn't become optional because copper costs more. Data centers still need power delivery. This demand is happening regardless of price. So the entire adjustment has to come from price rising until marginal demand gets destroyed or until substitution becomes viable. And copper substitution is really hard. Aluminum can replace copper in some applications, but not all, and aluminum production has its own constraints. Now let's add another layer, China. Because no commodity story is complete without understanding what China's doing. And this is where it gets complicated. China consumes roughly 55% of global copper. They're the largest buyer by a massive margin, and their demand is driven by infrastructure, real estate, manufacturing, and increasingly renewable energy and electric vehicles. China's 15th five-year plan is expected to be approved in March 2026 at the National People's Congress. And all indications are that it will continue prioritizing infrastructure investment in grid upgrades, renewable energy, and digital infrastructure. That means sustained copper demand. But here's the question everyone's asking. Is Chinese demand peaking? Chinese real estate, which has been a massive copper consumer, is in trouble. Property development has slowed. Does that offset the growth in renewables and EVs? Maybe, maybe not. But here's what matters. Even if Chinese demand growth slows, it's not going negative. China's not going to tear down their electrical grid. They're not going to stop building data centers. At worst, their demand plateaus. And the rest of the world's demand is accelerating. Europe's electrification mandates, America's infrastructure bills, India's industrialization. The demand side of the equation is growing no matter what China does. Let me tie all of this together because when you see how these pieces connect, everything changes. You have three structural forces happening simultaneously. Number 1, unprecedented electrification. Electric vehicles, renewable energy, grid modernization, all copper intensive. All mandated by policy. All happening in the next 10 years. Number 2, supply inelasticity. New mines take 16 to 29 years to develop. Existing mines are facing declining ore grades. There's no quick fix. Number 3, concentrated supply risk. 61% of production comes from 5 countries, and every one of them has constraints. You put those three forces together, and you get a market that's fundamentally mispriced. That $13,200 per ton? That's not the top. That's the market starting to realize the bottom is higher than anyone thought. Now let me address the skepticism, because I know some of you are thinking, this sounds too good to be true. This sounds like someone trying to pump a commodity. So let me be clear. I'm not telling you to go buy copper futures on COMEX or the London Metal Exchange. I'm not telling you to dump your savings into mining stocks. What I'm telling you is this. Pay attention to what's happening in physical commodities, because the financial markets are slow to price in structural changes. By the time the average investor realizes copper is in a multi-year deficit, the price will have already doubled. The opportunity isn't in chasing the move. The opportunity is in understanding the move before it happens and positioning accordingly. Maybe that's exposure to copper mining companies like Freeport-McMoRan or Southern Copper. Maybe it's understanding how copper prices affect input costs for manufacturers and adjusting your equity positions. Maybe it's realizing that the entire electrification trade is dependent on copper supply, and if copper becomes a bottleneck, the whole thesis changes. Here's a hard truth that might sting a little. Most people treat commodities like they're abstract numbers on a screen. They forget that the physical world has constraints. You can print more money. You can create more financial assets. You cannot create more copper. It has to be dug out of the ground, and the ground is running out of easy deposits. The financial system is built on the assumption that supply can always respond to demand given enough time and capital. But that assumption breaks when the time required exceeds the time available. And in copper, we're watching that assumption break in real time. Now we're getting to the part where it all clicks together, so stay with me. What separates this copper rally from every previous cycle is the demand profile. In past cycles, copper demand was driven by construction and manufacturing. That demand was cyclical. When the economy slowed, demand fell, prices corrected. This cycle is different because the demand is structural and policy-driven. Governments have mandated electrification. They've committed trillions to infrastructure. They've set timelines that don't move. 2030, 2035, 2050. These aren't goals. These are legal requirements. Automakers can't sell combustion engines in California after 2035. European countries have even stricter timelines. You can't lobby your way out of physics. You can't negotiate with a mandate. The copper has to come from somewhere. And here's the final piece that makes this so significant. The repricing isn't done. $13,200 per ton sounds like a massive number because it's an all-time high. But when you do the math on what copper needs to cost to incentivize enough new supply to meet 2030 demand, the number is higher, much higher. Goldman's $15,000 forecast by 2035? That might be conservative. Some analysts are talking about $18,000 to $20,000 per ton in a sustained deficit scenario. Because remember, price is the only mechanism to balance this market, and it has to rise until something breaks. Either demand gets destroyed, which seems unlikely given mandates, or new supply comes online, which takes decades, or substitution accelerates, which is technologically difficult and expensive. One of those three things has to happen, and until it does, price keeps climbing. Let me bring this back to something tangible because I don't want this to feel like abstract market theory. Think about what this means for the real world. If copper prices double from here, the cost of building an electric vehicle goes up. The cost of building a data center goes up. The cost of upgrading the electrical grid goes up. Those costs get passed on, either to consumers through higher prices, or to governments through higher infrastructure spending, or to corporations through compressed margins. Inflation in copper becomes inflation everywhere copper is used, which is everywhere. This isn't just a commodity story. This is an inflation story. This is a policy story. This is a who pays for the energy transition story. And most people haven't even started thinking about it yet. Now let me tie all of this together, because we've covered a lot of ground and I want to make sure the big picture is crystal clear. Copper just hit $13,200 per ton, 43% gain year over year. Best performance since 2009. And the reason isn't speculation or temporary disruption. The reason is fundamental. Demand from electric vehicles, artificial intelligence infrastructure, and grid modernization is accelerating. Supply from mining cannot keep pace because new mines take 16 to 29 years to develop and existing mines face declining ore grades and concentrated geopolitical risk. The result is a structural deficit that gets worse every year, and the only way the market can balance is through price, which means 13,200 might just be the beginning of a multi-year repricing. The financial markets are starting to wake up to this reality. Institutional forecasts are climbing. Investment banks are revising their models, but the average person still thinks copper is just another commodity that goes up and down. That's the opportunity, not to chase the price, but to understand the structure, to see the forces that can't be reversed quickly, to position before the consensus shifts. Whether you're trading futures, investing in mining equities, or just trying to understand where the global economy is headed, copper is the metal to watch, because it's not just a commodity, it's the physical backbone of electrification, digitalization, and modernization, and the world needs a lot more of it than the ground can provide in the time frame required. That's not bearish, that's not bullish, that's not bullish, that's just math. And the market is finally starting to do the math correctly. Remember that 43% gain? That's not the end of the story. That's the market repricing the starting point. That's the recognition that the old price anchors don't work anymore. That copper at $4,000 per ton assumed a world with slower electrification, longer timelines, and responsive supply. That world doesn't exist. The new world requires a new price. And we're watching that repricing happen in real time. Here's what I want you to take away from this. The biggest opportunities and the biggest risks come from understanding structural shifts before the market fully prices them in. Copper is in the middle of one of those shifts. The supply and demand fundamentals are broken. The timelines don't line up. The constraints are real, and the price is adjusting. If you understand that structure, you can make better decisions. Whether that's in your portfolio, your business planning, or just understanding why the cost of everything seems to be going up. Because copper doesn't just affect copper, it affects everything copper touches, which is everything that uses electricity, which is everything. Your future self is counting on you to understand these structural trends before they become obvious. 10 years from now, people will look back at copper prices in 2026 and say, of course it went higher. The demand was always going to outstrip supply. But right now, in this moment, you have the chance to see it while it's still developing, to understand the forces, to position accordingly, to not be surprised when copper hits $15,000, $18,000, $20,000 per ton. Because the math says it has to. The mandates say it has to. The physics say it has to. The physics say it has to. The only question is how long it takes and what breaks along the way. So here's my question for you. What topic do you want me to break down next? Lithium and battery metals? The real estate market and mortgage rates? Tax strategies for high earners? Drop it in the comments below, because this channel exists to make sense of complex financial topics that affect your life. And I read every single comment. You're not just pushing a boulder uphill anymore. You're understanding why the hill exists and who decided it should be this steep. That's the difference between reacting to markets and anticipating them. That's the difference between hoping things work out and knowing what to watch for. And that's how you build real wealth in a world where the rules keep changing but the fundamentals remain the same. Copper has to come from the ground. The ground is running out, and the world needs more of it than ever before. Everything else is just details.